Hello and welcome. After a truly historic run in 2025 that took Bitcoin past $126,000, the market is now standing at a crossroads. The period of easy agreement is behind us, and it's been replaced by a really deep, compelling debate about what happens next.
So this is the central question for anyone watching the market as we head through 2026. And on this, the experts are completely divided. We're seeing two fundamentally different ways of reading the exact same data, leading to two very different conclusions about where we go from here.
To really get a handle on this uncertainty, we need to look at both sides of the argument with a clear, objective eye. So, let's start with the optimistic take, the case for why this bull run might have a lot further to go.
Okay, so proponents of a continued rally are basically arguing that this cycle is different. It's not like the ones we've seen before. They're pointing to some powerful new structural forces that are driving demand in a way we've just never seen.
And the first most obvious signal is just the sheer amount of institutional money flowing in. We're talking about total inflows into spot Bitcoin ETFs nearing $60 billion. Now, this isn't just the usual retail speculation. This is a deep, structural shift. It's demand from the world's largest asset managers, and that creates a kind of baseline of support that just wasn't there in previous cycles.
And, this newfound institutional confidence is leading to some incredibly bold predictions. You're seeing analysts from major banks like Standard Chartered here suggesting the rally has much, much further to run, with price targets that, frankly, would have sounded absurd just a few years ago.
Now let's zoom out to the bigger picture for a second. The global M2 money supply, which is a pretty broad measure of all the cash in the system, is growing at over 9% a year. This constant expansion is what fuels Bitcoin's core story as a store of value, a potential hedge against the slow erosion of traditional currencies.
And this is where it gets really interesting. Even with the price at an all-time high, some of the key on-chain metrics aren't flashing red. Take the MVRV Z-score. It's basically a tool to see if the market price is fair compared to what people paid. Right now, it's at a level that, historically, we see closer to market bottoms, not frothy tops. That suggests there might still be room to run before things get overheated.
However, for every single bullish signal, there's a compelling counterargument. So now let's flip the coin and examine the evidence that suggests this cycle has in fact already peaked and a major correction could be on the table.
A huge piece of the bearish argument comes down to history, specifically the incredibly consistent 4-year halving cycle. This is a pattern that's tied to the program production and new Bitcoin supply, and it has historically set the rhythm for the entire market.
So if we just project that historical pattern forward, a peak would be expected about 12 to 18 months after the April 2024 halving. Well, that timeline puts the cyclical top squarely in late 2025, which is exactly when the market hit its all-time high before pulling back. For people who follow these cycles, that's no coincidence. It's the pattern playing out just as it always has.
And this view isn't just based on cycles. It's shared by technical analysts who study market psychology through chart patterns. For instance, using a method called Elliott wave theory, analyst John Glover made this very definitive call after a key technical breakdown back in October 2025. He believes the bull market is done.
His analysis, which is based on these wave patterns, suggests the market has finished its big upward move. He's now forecasting a potential drop into the $70,000 to $80,000 range, arguing that the whole structure of the market has flipped from buying to selling. Now, this data point highlights a really critical conflict. While all that new institutional money is flowing in, it looks like the smart money, the veteran investors, have been selling. The amount of Bitcoin held by long-term hodlers has fallen by a pretty significant 11% since the start of 2024. This suggests the experienced players are taking profits, and that creates supply that the market has to absorb. So, how on earth do you reconcile these two completely opposite views? Well, this is the point where we step back from trying to predict and we move toward understanding. The key is to recognize that the market is defined by this conflict of powerful forces. When you lay it all out like this, you can really see the market being pulled in two directions. It's like a giant tug of war. You have new, powerful forces like the ETFs clashing with old, historically reliable patterns like the halving cycle. This fundamental conflict, this is the reason for all the uncertainty and volatility we're seeing right now. So instead of trying to predict the winner of this tug of war, a much more practical approach is to just have a framework for observation. If you know what signals to watch, you can interpret what's happening with clarity rather than just reacting to all the noise.
And really, it all comes down to these three things.
These metrics are going to be crucial for figuring out which story, the bullish one or the bearish one, is winning out. Central bank policy, the persistence of those ETF flows, and what the Varen holders are doing. Together, they will tell the story of the market as the year goes on.
Ultimately, in a market this complex, the goal isn't a price target. Understanding the battle itself is far more valuable than betting on a specific outcome. Think of it less like having a crystal ball and more like having a clear map of the battlefield. And so this is the fundamental question for the year ahead. You have the undeniable structural change from all this institutional capital, but you also have the compelling power of historical market patterns. It's a true unstoppable force meeting an immovable object, and now you have the framework to watch it all play out for yourself.